Good morning to our webinar for the newly launched KWIN ETF, the KraneShares Wahed Alternative Income Strategy. Welcome to our global audience from around the world. We wanted to share information about this ETF today because it's designed to produce a compelling income stream while only owning securities that meet rigorous screening for values-based and Shariah investors. My name is Jonathan Shelon. I'm the Chief Operating Officer at KraneShares, and I'm joined by Ibrahim Shaikh. He's the Head of Investments at Wahed. Wahed is a well-known fintech and robo-advisory firm specializing in Islamic investing, and Ibrahim oversees global portfolio allocations and new fund mandates across their investment platform. He's got a deep background that spans global mutual funds, sovereign and institutional mandates, as well as private wealth portfolio management. Now, we're going to split our time today between a brief presentation and then a Q&A. I'll kick us off to discuss the ETF landscape, how we developed KWIN, and some of its features, while Ibrahim will cover the Shariah perspective and portfolio context for this strategy. Now, before we get going, I have a big favor to ask. We want this to be an interactive and lively conversation. And in fact, we plan on spending half of our time in that Q&A format. We're live streaming this presentation on our website and also at KraneShares.com and on Zoom. So if you're viewing this from the website, please email your questions to info@KraneShares.com. Whereas if you're in the Zoom, please submit your questions via the Q&A button at the bottom of your screen. Additionally, we are offering one CIMA and CFP credit for watching this presentation. And if you'd like credits, please email us at ce@KraneShares.com with your CIMA or CFP numbers to get credit. So let's jump ahead and do a quick intro on KraneShares. For those of you that don't know us, at KraneShares, we manage about $13 billion across 41 ETFs around the world. And we're best known for delivering innovative, first-of-its-kind ETFs that complement every portfolio, like KWIN. We specialize in global investing with an emphasis on EM in China, climate, and alternatives. And alternatives, in our case, include strategies that use options, like KWIN does, but also uncorrelated categories of investment. So if you look on the next slide, you'll see the full suite of strategies that we offer. And you could see that we're very well known in the China space and have a number of offerings there, but also in global equities more generally. And of course, on the far right of this slide, you could see fixed income and carbon-based strategies. So this is a very robust suite, and we're very proud of the time that we take to develop strategies as an ETF issuer, but also in the partnerships that we build with firms like Wahed to complement the skills that we have here to bring new things to market. Let's jump ahead, please. Now, in preparation for launching KWIN, we studied the income space considerably. And one of the things we noted is that over the last several years, there's been an absolute explosion in AUM growth for money market funds and ultra-short bond funds. Now, some of this, I think, was driven by the fact that we had rates rising very rapidly, and people were seeking out ways to access yield. And historically, the way that people reached for yield was by, investing in higher yielding funds, taking on credit risk or taking on duration risk. And we think that's why the ultra short bond space became so popular too. People were willing to go a little bit beyond short-term rates to get a little bit of extra yield. But over the same period of time, there's been another set of strategies that have become really quite popular in the ETF space. And those are the derivative income strategies. And you can see that chart on the right. It's gone exponential post-2021, again, at a period of time where rates began to rise sometime in 2022 and have continued to rise up until really quite recently. And now that area represents $146 billion. Now, many of those derivative income ETFs are in the covered call category. So those have become very popular. And in fact, about 3 years ago, we launched our own covered call strategy at KraneShares called CLIP, based on our China Internet strategy, KWEB. But what we found is that the challenge with a lot of derivative income strategies is that they require you to take on market risk. So if you think about it, if you're doing a covered call writing strategy, you have market risk. If you even do a buffered strategy, there's market risk beyond the buffers. So using derivatives is an extremely effective tool as long as you understand the risks. So as we were thinking about creating an alternative income strategy, one of our guiding principles was, how do we strip out the market risk? How do we make it market neutral? Because if we want to give people an alternative to traditional money market strategies or traditional ultra short bond strategies or Sukuk strategies, how do we do that without taking on market risk? So if we turn the page. And so that brought us to looking at strategies that have been commonplace within the option world for decades and used by corporate treasurers and treasuries to extract financing rates that are embedded in stock options. Some of those strategies are called box spread strategies, and others are called RevCon strategies, reverse conversions. And what we've adopted in KWIN is a form of a RevCon, actually the conversion side of it, and we'll talk more about those details. But these strategies have been around for decades and decades and used by sophisticated institutions and corporate treasurers, but they've not historically existed in an ETF wrapper. So one of the innovations here with the KWIN strategy is that we've taken something that historically was not readily available broadly to investors, and we've made it available within an ETF. And it's designed to generate income levels that are competitive and oftentimes higher than what we see with money market rates. Next slide, please. So the idea here for the strategy for KWIN is to generate an alternative income source, an income source that does not produce interest per se, but captures option premium by buying a stock and then entering into what is effectively a forward contract to sell that stock using calls and puts. And we'll get more into those mechanics very shortly, but basically we're buying a company and then we're selling that company or its economic exposure, but at a slightly higher price, and are able to collect that premium, that difference. And we do this for a basket of 25 companies. And these companies are very carefully screened with the help of Wahed and their screening process that ensures that we're aligning with values-based and Shariah investors. So let's jump into a little bit more detail about how this actually works. How are we doing this transaction? Why does it make sense? So we're going to use the example of Amazon here. And imagine you buy Amazon stock. Amazon's a large company, it's very liquid, and it has a large and liquid options market. So if you buy Amazon stock, you own the upside and you also own the downside. And based on my prior example, or what I was communicating before, we don't want to have any of the market risk associated with Amazon stock. So the most logical thing to do first is to buy downside protection. Amazon is volatile. So let's buy the stock and also buy puts, buy options that protect the downside. And let's buy those puts over a short period of time, say 3 months. And then on the other side, let's sell calls. Now, it turns out that if you follow put call parity, which we do believe in and is a thesis of making this strategy work. Under the principles of put call parity, when you sell the call, it's going to be a little bit more expensive than the put, assuming you have the same strike price, time to expiry, and other features. So by buying a put and selling a call, we're going to net a little bit of premium. And that little bit of premium is going to be a lot like a rate of return that's similar to short-term interest rates. And we'll talk a little bit why it actually could be higher and is higher today than short rates. But that's the thesis. Under put call parity, if we buy a stock, protect the downside with a put, and sell the upside by selling a call, we're able to collect that difference right away. Next slide, please. Now, if we were to do this using regular listed options, we would create some risks. And some of those risks have to do with the risk of being exercised early. When you own US securities and you invest in the US options market, they're called American style options. And these American style options could be exercised at any time. That would be a risk for us in managing the portfolio. So we've opted to use something called flex options. Flex options are still listed options. They're not over the counter. They're listed on exchange, but they give you the ability to customize certain terms. And in our case, that customization is going to be around expiry. So we're going to flex the options that we own from being American style to being European style, which means they can only be exercised at the end of the period when the options expire. And that's good for us. That's what we want, because at that point, we're just going to roll into another set of contracts. So the idea here is to invest in a stock, buy a put, sell a call, flexing those options to being European style, and thereby making this basket of stock, put, and call market neutral, meaning we're not exposed to variations in market movements. In that example where Amazon is up 10% or down 10%, we're not exposed to that market risk, and we're left with our premium that we've collected, which can be used or viewed as earning a return or a yield. Next slide, please. So let's talk about the process that we've adopted for KWIN, just to make it very clear. As I'd mentioned before, we only invest in US stocks. We don't buy ADRs or preferred stocks or anything else. We screen for common US stocks. And the stocks have to be listed on major exchanges like the New York Stock Exchange, the NASDAQ, or SIBO, and they had to have been around for a while. We're not going to buy that new IPO that just came out. The other thing that we ensured is to strip out dividends. When a stock pays dividends, it could impact the strategy. So we've screened out for companies that don't historically pay dividends, the non-dividend payers. And then finally, once we have that universe of stocks, US stocks listed on major exchanges that don't pay dividends, we apply a screen with Wahed as the sub-advisor, where we take out companies that would be involved in tobacco or alcohol or firearms and so on, to make sure that these are companies that abide by values-based principles in Shariah. So let's jump ahead to the next slide. Now, what's interesting is we've been managing this strategy now for a little while. And if you look at the option income that was produced for each and every security, and these are the 25 companies that we own. Some of these are obviously very well-known names, Uber and Tesla and Amazon and Adobe and so on. These are really very well-established companies that pass the screens, but you could see that the annualized option income was somewhere in the 5% range for most of these names. Now, I want to caution you on a couple of things. These are option premiums that we have collected historically when we put on these positions, when money came into the fund and we put on these trades. And that happened before the Fed just announced rate cuts. So it's important to note that while these numbers are the numbers that we have achieved that are in the portfolio today, they're not representative of what happens in the future. So as new money comes into the fund, invariably, it's going to achieve whatever the market rate is at that time. And if the Fed continues to cut rates, the rates will be lower. But what you'll notice is even before the rate cut, when the Fed funds rate was 4%, this level is higher than that. And that's because even though put call parity does apply, and you would expect to extract from options what is known as the risk-free rate, oftentimes the way options are priced include not just the risk-free rate, but also something known as a convenience yield. And part of that is because there tends to be a preference for owning the underlying stock. So if somebody is synthetically owning stocks just by using options, they usually have to pay a premium to achieve that result. Well, in our case, we're selling a stock effectively by using options. And so we get to collect that incremental return. So this convenience yield varies from time to time. It could get larger or smaller depending on what market conditions are. But historically, it's tended to be positive. And so what that means is that embedded in this strategy is not just the risk-free rate that's achieved in the treasury market, but something that's a little bit extra, but not perfectly predictable. Next slide, please. And you could see that we work very closely with a firm called Mercube to develop an index for this strategy. So while there is a screening process and trading and decision-making that has to happen, we wanted to make sure that what we're doing is transparent and that the methodology is perfectly visible and disclosed. So we worked very closely with Mercube to develop the Wahed Shariah Alternative Index. And you can see here since July what the performance of that index looked like. And as I'd mentioned before, it's designed to create a smooth ride, if you will, and an alternative to money markets and ultra short bonds. So there is a little bit of noise day to day just because of the mechanics of the option market and so on. But by and large, our expectation is that the strategy will continue to grow steadily with a little bit of day-to-day variation as it has here in these early months. So we're very pleased with the performance that we're delivering. It is a new strategy, but it's attracting client interest already. We're having a lot of conversations with investors, with institutions that are interested in learning more, because when you consider the alternatives, particularly for Sharia-focused investors, this is really something new and exciting for many of them to be able to get access to. So at this time, what I'd like to do is kind of switch gears and turn things over to my partner, Ibrahim, and let him walk you through some of the finer aspects and details behind the investment strategy. Ibrahim.
Thanks, Jonathan. Appreciate that. Those were some great insights. And thank you, everyone, for joining us today. Just briefly on Wahed, for those who may be less familiar, Wahed was founded in 2017 as an investment platform with a mission to democratize Sharia-compliant investing. Right? We operate as a robo-advisor platform with over 500,000 users. So this year we've surpassed the 500,000, which is a great milestone for us. Our major markets are the US, UK, and Malaysia. And we are also among the first to bring Sharia-compliant ETFs to the New York Stock Exchange back in 2017 and 2018. And we're increasingly involved in fund design and portfolio solutions for our investor base, and partnerships with firms like KraneShares are pivotal to that approach. I'm going to walk you through the Sharia aspects of KWIN strategy. And Jonathan's already done a deep dive into how the structure works. So my focus will be on how Sharia views the strategy, the interpretation, why it aligns with Islamic principles, and how it fits into modern Sharia portfolios, most importantly. So let's start by looking at the broader landscape of portfolio construction under Sharia, particularly when it comes to income-oriented exposure. So if we can go to the next slide. For most Sharia-conscious investors and portfolio managers, the toolkit for income-oriented exposure is still fairly narrow. Most portfolios depend on a combination of sukuk and Islamic money market strategies. For anyone who's unfamiliar with the term sukuk, those are Islamic bonds. And while both of these instruments, the sukuk and the Islamic money market strategies, they're essential to the ecosystem of Islamic finance, there are structural realities here that are worth recognizing. Firstly, with sukuk, issuance is often concentrated in sovereign and quasi-sovereign issuers, right? Primarily, these are based out of markets like the Middle East, Malaysia, and Indonesia. So when you look at sukuk portfolios and the constituents of sukuk funds, what you'll notice is that they're heavily skewed towards emerging market credit exposure. The other factor with sukuk that we must note is that investors in sukuk are generally of a buy and hold mindset. And you couple that with the fact that the supply of sukuk depends on issuer demand for credit. You have a situation where the secondary market liquidity and liquidity in general for sukuk is quite limited. Now, the other tool that Sharia investors have, which are Islamic money market funds, they rely heavily on Islamic bank deposits, and they maintain a meaningful cash buffer to manage daily liquidity. Now, when you take all of these factors together, as you can imagine, this can result in yield drag within Sharia compliant income portfolios, and also in low volatility allocation sleeves of just general Sharia portfolios. So, and you can imagine that these are allocations where yield is primary and liquidity is desirable. So for portfolio managers, these conditions create practical challenges like a persistent cash drag. There are limited short tenor tools, difficulty diversifying the source of returns without stepping outside of Sharia boundaries, right? So these are the practical challenges. And that brings us to a practical question. Can we have a trade-based strategy that is asset-backed, that's liquid and scalable, while remaining firmly within Sharia principles? And I think that that's where the KWIN fund is designed to play a role. If we can switch to the next slide, now that we've looked at the available tools and challenges, I'd like to go over how Sharia interprets the strategy. And the Sharia interpretation of the strategy is fairly straightforward. The fund purchases Sharia compliant equities, it custodies them, and at the same time uses exchange traded option contracts as a tool to structure deferred sale. And under this structured deferred sale, the primary trade aspects like the price, the asset itself, the delivery date, and the quantity, these are pre-agreed. The important point here is that exchange traded options are used as an operational tool to effect the structured forward sale. They're not used for speculation or open-ended optionality or the trading of rights, which are the primary concerns Sharia could have with the usage of options. As an added point, the economic substance of the strategy from a Sharia perspective is that of a deferred sale. The Arabic term for this particular structure is bay muajjal, and it's a classical form of trade compliant with Islamic principles. And secondly, when we look at the outcome of the strategy, the alternative income that is generated is from the difference in the purchase price and the aggregate structured sale price of the underlying equities. So in a nutshell, the strategy uses modern tools to give effect to a classical trade form under Islamic principles. And if we go to the next slide, I'd like to highlight 5 primary reasons as to why the approach resonates with Sharia conscious investors. And think of this as a checkbox, for Sharia compliance. The first is that the strategy is asset-backed, which is a primary requirement for Sharia. The second is that the terms of the structured sale, as we just discussed, they're clearly defined at the outset. Another requirement that's primary to Sharia principles for a trade to be valid. The third is that the strategy involves no leverage, no borrowing or lending of any kind, right? The fourth is transparency. And you know, the structure is pretty clear. Investors can track the flow of capital through each stage of the strategy, right? From the purchase of the stocks to the structuring of the sale contracts through to delivery. And lastly, and importantly, the strategy is reviewed and certified by an external Sharia advisory, Abrahamic Finance. They're based out of Canada and led by Dr. Asin Lassasna, who's very well respected in the Sharia space. And it's also complemented by Wahid's own internal Sharia oversight, right? So I see some questions on the Q&A that are related to Sharia governance. So I'll just go over the next slide and address some of the questions that have been put up there. So when we talk about Sharia governance, and Wahid's view on Sharia governance is that it's not a point-in-time exercise, right? It's something that applies throughout the life cycle of the strategy. So in the initial stage of the strategy, as any Sharia fund is expected to do, we would screen the universe of equities based on the business activity, the primary business activity of the companies. So if we have companies whose primary business activity is related to, say, alcohol or gambling or tobacco, adult entertainment, as with any other faith-based investment mandate, we would exclude those stocks. The other screening criteria, which is partly unique to Sharia investing, is that we would also exclude companies whose financial ratios, particularly debt, exceeds a third of the average market cap. So essentially companies that have a very high debt. So like I said, this is expected of any Sharia fund, but for us, this is just the first step. Wahid ensures that the constituents are rescreened every quarter. We also ensure that the trade structure itself conforms to Islamic principles of a valid trade. So in a nutshell, it's not a point-in-time exercise for Wahid. It is maintained end-to-end through the life cycle of the strategy. And this brings us to the most important question, the crux of what we want to communicate here is how investors and portfolio managers can use KWIN funds in their Sharia mandates. If we can move to the next slide. So I think our view is that in Sharia portfolio mandates, the KWIN fund is intended to sit alongside Sukuk and Islamic money market allocations as part of a broader toolkit. The KWIN fund, it introduces a trade-based structure with economic drivers that are distinct from what you typically associate with Sukuk or money market strategies, right? With Sukuk, the primary economic driver is credit, and for money market strategies, the primary economic driver would be the short-term prevailing profit rates. With KWIN, it's more the structure, the deferred sales structure that would drive the returns. With being a different economic driver also supports diversification within the economic income-oriented allocation sleeves. And another important use, and in my opinion, the most important use of the KWIN strategy would be to deploy idle cash rather than leaving capital unproductive, something Islamic mandates often still struggle with. So, a point I like to reiterate, and Jonathan referred to this in some detail, is that similar structures have been used in institutional settings for many years, decades now, for liquidity, treasury, or cash management. And KWIN brings a similar disciplined approach that is also Sharia compliant. So, I think to summarize, KWIN uses a very well-established Sharia compliant structure in a fund format that investors can use within income allocations or to put idle cash to work. And in doing so, it broadens the set of tools available to Sharia investors. And that resonates strongly with the mission of Wahid. So let's, Jonathan, do you think it's good to move into the Q&A session?
Let me unmute here, and why don't we go to the next slide? And I'll just briefly summarize at a very high level what we discussed, and then we'll kick off Q&A. So,
sure.
As we mentioned, there's a lot of growth and interest in the derivative income space. We think that many derivative income strategies that are available as an ETF embed market risk. And so we've worked very hard with our partners at WAD to create a strategy that is market neutral, that strips away the market risk while still extracting an attractive and compelling rate of return over time. This options-based alternative, we think, can complement, it doesn't have to replace, but for many investors can complement their ownership of money market and ultra-short bonds if they're able to own those strategies, but can also be complementary to strategies that are used in Islamic finance. So we think that this is a very versatile ETF for Sharia-focused and non-Sharia-focused investors alike. And what I'd like to do, as Ibrahim pointed out, we're seeing a lot of really great questions. So we know we're going to have a fulsome conversation here. And let's switch over to Q&A. And if there are any other slides here that we have to put up on screen, we'll do that. But once we do that, I would end at the conclusion slide. Okay, so Ibrahim, great job. Very insightful. Geez, there's so much to choose from. Talk a little bit about, in terms of kind of the ongoing screening, you said that this is, there's kind of the starting process and the ongoing process. How frequently are you re-reviewing the portfolio, re-reviewing these names, and how does that align with the rebalancing frequency of the index methodology?
That's a good question, Jonathan. And from a Sharia perspective, like I said, it's not a one-off exercise. So you start out with a universe of equities that is Sharia compliant. If the Sharia compliant status of a particular security changes within a quarter, then you would rebalance at the end of the quarter, and you would make sure that the positions are not increased. So rather than be reactive, I think the way Sharia addresses such operational concerns is to have a orderly structure where rescreening is, the frequency of rescreening is quarterly, and it coincides with the rebalancing or the trade structure itself, so that we're able to offload any non-compliant securities every quarter.
Perfect. And there's another kind of related question to the mechanics, and you just touched on it. When money comes in to the ETF, we are then buying that basket that we talked about at that point in time. So when new capital arrives at the ETF, we go out and we buy that Amazon security, for example, and we buy the put and we sell the call. So it's that structured trade that Ibrahim referred to. But then what happens after? Well, these options, are really designed to mature over a 3-month period. So in kind of what we own today, those options will be expiring in mid-January. And at that time, we're going to roll the portfolio and purchase, everything all over again. Now, the idea in doing that has a couple of implications. One, we are reinvesting all the option premium that we have previously collected. So in other words, the option premium that was collected does not get paid out. We are not distributing each month or each quarter in this fund. We're reinvesting that right back into the fund. So our goal is to create a steady and growing NAV, net asset value, over time without any disruption from distributions. And we're also striving to do so in a tax-effective manner. So our idea is to achieve results similar to what's on screen here, and then allow investors to have the tax obligation that they have when they sell the strategy, but not along the way through distributions. There are certain distribution requirements for US-based ETFs that may be unavoidable, but our goal is to run this as tax efficient a manner as possible. So that's a little bit of insight into kind of the mechanics based on the maturity of the options, but also the review cycle that Ibrahim and his team conduct for the strategy. Let's talk a little bit about, let's see here. Well, there's a question about history. And we talked about, I mentioned that this could be an alternative to things like T-bills and ultra short funds. And Ibrahim talked about the Sukuk market. So the question here is, over the history, how would a strategy like this have performed? And presumably some of that difference has to do with the duration, right? This is by definition, a very short duration fund, if you want to think of it that way, because we're investing in a strategy that on average has a 3-month window each time, whereas my understanding of Sukuk bonds, and I'm the furthest thing from an expert, is they can have lengthier duration. Is that right?
Absolutely. I think they have lengthier durations. And even if you look at Sukuk funds, the average duration, the weighted average duration of a Sukuk fund would fall anywhere between 3 and 5 years at the minimum.
Wonderful. There's an interesting question here about, whether or not this is an arbitrage strategy, namely, is the result that we're producing one that's sensitive to the size of the fund, right? And I think that's a really interesting question, because it speaks to the fact that there's value, we're presenting value in what we've built, and whether or not that value declines as the fund grows. Well, one of the things that you recognize as you consider the basket of stocks that we own, these are some of the largest bellwether names in the US stock market, with incredibly deep and liquid options pools. And I would also mention that on top of that, the concept of a RevCon, the implicit strategy that we're using, a reverse conversion or a conversion, this is a very well-known strategy employed by institutions all over the world. So we believe that there is not a direct effect, and there could even be economies of scale with respect to trading in some of these names. For example, I think the opposite might be true, that if you're trading a very small size in a strategy like this, you're at a disadvantage, because the options market requires you to invest at least 100 shares worth for each options contract. So there's an element of size actually helping with, we think, scale and efficiency for a strategy like this. So I want to highlight that as an important point. We didn't build this to be a niche strategy for something that could be a few $100 million. We've built this because we'd like it to compete meaningfully with money market and ultra short bond strategies, which could be in the billions of dollars in terms of AUM and size. And that's our hope for this strategy as well. It's interesting. There's a question about how an investor should allocate. And Ibrahim, I know you have a ton of expertise in thinking about your robo business and how you would allocate. What kind of allocation is suitable for a client, for KWIN, if you think about a kind of a traditional kind of Shariah focused portfolio that you manage?
Right, absolutely. And, one of the points that we mentioned was that, KWIN is designed to sit alongside Sukuk and money market strategies that are, already available in the market. So in terms of allocation, and this is not, intended to be investment advice in any way, but if you're looking to reduce the volatility in your income sleeve, the allocation towards income generating assets, then you would find that a higher allocation to KWIN would serve you better. But if that's not a criteria that you're looking at, then perhaps you could theoretically generate a higher yield by having a higher allocation towards Sukuk. But we've generally seen that, at least in the last 5 to 7 years, that the allocation can be split between Sukuk and money market and KWIN in a way that slightly favors KWIN, because we've seen that rising interest rate environment.
And I would say that looking at it through kind of a non-Shariah lens, if you're thinking about this strategy just as an alternative way of delivering income in your portfolio and you already invest in things like money market and ultra short, I very much view it as a potential substitute or complement for either. So we're not suggesting that you need to replace everything you do in the liquidity space with KWIN, but it could certainly play a meaningful role because of the mechanism that we've employed, this market neutral mechanism to strip out the directional market risk and extract a rate that is the risk-free rate plus a convenience yield. So again, we think it's an attractive way of approaching your liquidity basket as an investor, and even if you're, say, kind of reaching for yield, which we hear a lot of investors are doing now, and taking on all sorts of other sorts of alternative income categories, call it private credit or CLOs and so on, which involve significant risk taking in many cases. This is actually a nice ballast to reduce risk in those types of portfolios. I'm going to try to address two questions at once because there's a great question here about what are the specific market conditions that might affect option premium and can it become more favorable? So, and this relates to another question about put call parity. What is put call parity and why does it ensure that you actually earn a positive option premium when you structure this transaction in buying a stock and selling the stock forward? And the answer is the put call parity is really a very simple mathematical formula that ensures that there's no arbitrage. It ensures a no arbitrage condition, because if you have the ability to buy and sell stocks and buy and sell options, if you don't satisfy put call parity, it creates arbitrage. And what that means is somebody can make risk-free profits by not having to do much. And so because the markets, especially around these particular options and these particular stocks, are very well followed and have a lot of participants, as you can imagine, there are a lot of firms looking for these arbitrage opportunities and trying to pick up a penny here and a penny there. So that kind of ensures that put call parity does in fact apply to the relationships that we're looking at. And what it means is that if you own a put and a stock, that has to equal to owning a call plus the present value of the strike price. And so it's really just four components: put plus stock equals a call plus the present value of the strike price of those options. And so what that means is that if you rearrange that and you say put plus stock minus call, that has to equal to the present value of the strike price. So in other words, putting that transaction into place, which is what we're doing, put plus stock minus call, that has to be at a discount to the cost of the stock. And that's exactly what we're collecting. We're basically collecting that discount up front and then just waiting for everything to mature and settle. And so that's why it works. And again, the real question is, could it be more or less? And the primary determinant on whether or not that option premium is more or less is the level of the risk-free rate. So obviously what the Fed is doing is very important. And in our case, because of the tenor of the options, 3 months is the rate that's most relevant for what we do. But as I'd mentioned before, built into the options market is something known as a convenience yield. And that convenience yield represents an additional spread, a requirement that the options market needs to embed inside of options pricing. And that spread can widen, particularly during times of stress. So during something like the financial crisis, you actually see that convenience yield being higher, which again, I'm not viewing as a selling feature of the fund. I'm not trying to suggest that when things are rough, you're going to make a lot more money here. Historically, we've seen that occur, that spread widen during times of stress, but the spread remains pretty small and has remained pretty small, but we think still attractive for many investors. So I know that was a bit of a technical explanation on put call parity, and convenience yield, but I thought it was a way of covering some of these questions. Ibrahim, are there other questions here that you see that you'd like to cover, or anything that we haven't talked about yet?
Yeah, I think there's one question about how the strategy can replace or complement Sukuk and money market allocations. I think we covered a bit of that, but there's another one on that specifically refers to how much of Sukuk allocation should they move into a strategy like this. And I think liquidity or requirement for liquidity is one of the factors that investors should consider. I mentioned during the webinar session that liquidity in Sukuk markets can be quite challenging. And just to give you some statistics on how the Sukuk market is placed, is that you have about 930 billion size of the market in Sukuk. This is as per Morningstar at the end of 2024. And only about 6 billion of that is in funds. The rest of it is held by private investors and Islamic banks, and those are buy and hold investors. So that's the liquidity pool that you're looking at. And so when you compare that with a strategy like KWIN, you can imagine that liquidity becomes a big consideration in choosing the allocations and the right investment for you.
Yeah, that's an excellent point that we didn't spend a lot of time on, right? This is an ETF, which means that investors can access it at size. The ETF has already grown very quickly. It's upwards of $35 million, and it's relatively new. And so it shows that there's an ability here to really invest at size, both in and out. So if an investor is concerned about trying to search for yield or reach for yield by taking on illiquidity risk, this is a way of mitigating some of that and creating liquidity in a portfolio that otherwise may not have that much.
That's a great point, Jonathan.
And again, I would just highlight, there's a question about expectations for annualized option income, and I think we spent time on it, but it's just worth repeating that the rates in this portfolio are going to track what's happening with short-term Fed funds rates, plus a bit of a spread, and obviously less our management fee. So those are kind of the mechanics of the underlying fund. And because we're not distributing on a regular basis, we expect the NAV to be increasing by that the option income that we generate in this strategy, less the fees that are incurred. So it's very straightforward. The mechanics of it are a little bit technical because it does use options, but this is an area that's becoming very, very popular. And we didn't do it for popularity. The popularity helps because it means that investors have become more comfortable investing in options-based strategies. We did this because we think it brings something really innovative to the market and satisfies the needs of Shariah and non-Shariah investors alike. So we're really, really excited about bringing this forward. And we know that investors will appreciate having this as an additional tool in their global asset allocation toolkit. Ibrahim, any other questions or any comments that you'd like to make before we close the webinar?
I think we've addressed all of the Shariah-related questions in the Q&A box that I have here. So there's not much else from me, Jonathan.
Wonderful. Well, thanks again to all of our investors around the world. We're delighted that you joined us today and spent time learning about KWIN, the KraneShares Wahed Alternative Income Strategy. And if there are any questions that we didn't address, or you would like to have materials regarding the strategy, or speak to either myself or Ibrahim at length on any additional topic, please do reach out to info@kraneshares.com. And we look forward to engaging with you in the future.